Now, when we look at the dollar for Forex traders, you're really going to be focusing on like the London Open Kill Zone, the New York Open Kill Zone. And again, for the London Open Kill Zone, it's all New York local time. It begins at 2 a.m. and ends at 5 a.m. Now, I personally, I use 1 a.m. as a buffer. And to me, that kind of like cancels out any tomfoolery that would occur because of daylight savings time, which I wish they would abolish it. I mean, it was the stupidest thing to implement anyway. In some parts of the world, they don't even use daylight savings time. But to remove all the uncertainty about time, I've always used my personal is 1 a.m. to 5 a.m. Okay, that's the time. So that means any setup that I like to look for can occur that early, which is kind of like the European Open. And then you have at 2 o'clock, it's the London Open at 2, and it usually closes up shop and the volume peters off at 5 a.m. And in between 5 o'clock in the morning to 7 o'clock in the morning, I refer to that as dead time. Don't try to do too much anything in here. But I have taken trades as early as 6 o'clock in the morning, trading the New York session or the New York Open Kill Zone, which is classically defined by 7 o'clock in the morning to 10 o'clock in the morning. And you can look at 7 o'clock to 9 o'clock as that little sweet spot where the majority of your trades are going to form buy or sell for Forex trading between 7 o'clock in the morning and 9 o'clock in the morning. The London Open, I talked about this moments before we took our first break. At 7 o'clock, I'm sorry, at London Open at 2 o'clock in the morning and 5 o'clock in the morning, New York local time. That is the ICT London Open Kill Zone that if you know where the weekly candlestick is likely to draw to, everything I've been talking about up to this point is how I do it. There is no shortcut version of it. It's just the market's going to go up to a gap or it's going to go up to an old high if it's going to go up. If it's going to go down, it's going to go down to a gap below price or go below an old low. That's it. How you define which one it is what has it done recently? How has it traded? Is it leaving a range that we've worked multiple times back and forth and it's been efficiently delivered and we left that range? Chances are it's probably going to expand lower, reaching for an old low or inefficiency in the form of a fair value gap below price, or reverse it. It's that simple. And what you're wrestling with is you're trying to bring other things that you either know you learned from somebody else, some kind of other indicator-based idea or retail perspective, maybe supply and demand, maybe Elliott wave, maybe harmonic stuff. You're trying to bring that into this and see where you can help your understanding by bringing that in. And that's the mistake. Leave all that stuff at the door. So if you look at the range here, we're going to measure the high. I'm trying to find a point where I can lay it on the low. Okay. So we can see that the highest point here, and it might not be the very pipette, I could care less about that, but the low and the high, I've dropped the Fibonacci on that. And the only thing I'm using the Fibonacci for is to show you the relationship of the 3 specific price levels that I teach my students to look at. So if we're looking at the high, okay, I'm trying to see what that number is here. Okay, 103.445. The low, 103.226. Okay, they may or may not be the actual high and low of the weekly candles that are used to define that range, but I think this is close enough for government work. So the midpoint is 103.336. The midpoint of any gap, that being a fair value gap or a real liquidity void. A liquidity void would be like this little area right there. See, there's no overlapping of any wick or candle body. It opened here and it closed here. There's no price data here at all. That's a real liquidity void. That's a real gap. We refer to things like this here as a fair value gap, and this would be in the form of a buy side imbalance, sell side inefficiency. This is a real liquidity void. Any gap, whether it be liquidity void, or inefficiency, or like I have it shaded here up here, they're measured from the highest high and the lowest low of that respective inefficiency or gap. And the midpoint is always referred to as consequent encroachment, meaning that as it starts to fill in and reprice to the high or low of these levels, as it encroaches, it's most likely to refer to the midpoint of the gap or inefficiency than the extreme high or the low. And that's the basis of why we like to see, if we're bearish, we want to see the upper end of the inefficiency or gap respected and treated as a premium and not be dug into. Meaning, as I mentioned before we took our break, we don't want to see the high end of any inefficiency be retraded to if we're bearish. If the market is really, in fact, in a sell model, the best ones, the strongest delivering obvious runners, will always have this signature hallmark part to it where the upper portion of it doesn't get traded to. Look at the bodies of the candles. We have just a little bit of movement above it here, but look at these right there, right on that midpoint of that. You think that's random? When I talked about it on the 13th of June in that live stream, I said, I want to see, does this show signatures in price action that confirms, it suggests that my assumptions, by anticipating this level that's shaded in a pale orange, that would be treated as resistance or a means of beginning short trades for smart money. And in targeting this level down here, which is the bullish order block on the daily chart. No, I'm telling you how to frame a setup. Every element that makes up a trade has to have several factors. It's the inception of a move, where it begins, but by itself, there has to be some narrative, reason why that trade should even form, which is what I've spent all this time thus far explaining, why we're seeing what we're seeing in the chart right now, which is what I outlined and told you was going to happen on the 13th of June. You look for, in time periods of the day where I teach you as kill zones, London, 2 o'clock to 5 o'clock in the morning, New York local time. If we have a bias, okay, for the number crunchers out there, if we have a bias that is indicating that the market is likely to expand lower on the weekly chart, that means the candle's going to expand down. Right away, 80% of your bias problem has already been solved by itself with that alone. But you have to wait for all the calendar events to either support or negate the idea. So we had a series of big news events, big news drivers this week. FOMC, CPI, all those things you watched me and showed you how to navigate them. Not to trade ahead of them, but after you see that information come into the marketplace and all the sentiment shift that they create. We're not looking at the data. We're not seeing what the raw number suggests. I could care less. I never look at that stuff, folks. It's never a factor. But I'm anticipating the medium or high impact news driver to create and present volatility. And in that volatility, we're looking for, where does the stops rest after that first initial move? Where do stop losses reside? Above old highs or below old lows? Where are those highs and lows? We don't know where they're going to form before CPI. We don't know where they're going to form before FOMC does its first move. We don't know where non-farm payroll is going to use the high and low that it creates after the initial run at 8:30 when that news driver comes out, which is the reason why I tell you as my students, don't trade those. You don't know what you're doing. I don't know what they're going to do. They could manually intervene and send these things wherever. That's gambling. I'm not gambling. I'm not trying to inspire any of you to try to throw darts and see if you can get a bullseye where there's no skill involved. That's happenstance if you make money, but mostly you're going to lose. So what we do is we wait for that initial manipulation to come into the marketplace that you can schedule and set your watch to, and it's all on the economic calendar. The economic calendar is going to tell you the time of these reports that are coming out. The market is not moving because of the report, period. If you're bearish, as we've been expecting since the 13th of this week, we want to see how does price gravitate to this level down here, which is that bullish order block. So each individual day, we have to weigh out, does it run into that shaded area up here, which is what I outlined this. We want to see, does the algorithm offer price there? And if it does, once it enters it, at what time of day? Well, what market are we looking at? Dollar. So primary interest is nailing down the high of the day. Where is the high of the day going to form in a market that is trading at a level we expect the price to react to? So we're expecting the inception of a down move between one of three levels in here, right? No. Midpoint or the low of that shaded area. Remember what I said. If we're bearish, every inefficiency, if we're going to use it as a basis or a framework for a trade, we want to see in a premium array that's going to be used to sell off and send price lower, we don't want the upper portion to be respected. Because if it doesn't get up there, like we're seeing right here, that's really indicating that this is going to be a strong probability. For what? The trade down to and through that order block. Time of day now, okay? Got this fancy kill zone indicator right here. I draw off my annotations out, folks, by hand. I know that you like to have these little gizmos that do it, but nothing beats high touch over high tech. It makes it more meaningful to you. It's like meditation for me, and it's a little tedious sometimes when I have to do a whole lot of annotations, but when my heart's in it like this, I don't mind doing it. So here's London Open, and we're dealing with the dollar index. And I mentioned on the 13th that we would want to see the price of dollar go up into this shaded area, which is the old inversion fair value gap on the weekly chart. So we've taken that weekly chart fair value gap and transposed it to all time frames lower than it. So that way, whatever annotations you put on your weekly chart, you want to make sure that you show that annotation on all time frames. And how do you do that? You highlight the array that you're annotating on your weekly chart, and then current interval and below, or all intervals is basically the same thing. Then you'll see it on every time frame when you go through your higher time frame weekly, daily, 4-hour, 8-hour, 15-minute chart, 30-second chart. It'll always be there. Okay. Inside this window of time that begins at the left side of that London Open Kill Zone annotation box to the right side, in this area is when the trade begins, when the shift in market structure will occur, when the high of the day forms. 70% you have a probability that the high of the day will form between 2 o'clock in the morning and 5 o'clock in the morning, New York local time. But you have to have the other ingredients. You can't just simply say, okay, highs and lows, let's run some numbers and calculate, does the high of the day form on 2 o'clock to 5 o'clock on this day, this day, this day? No, you have to have the narrative in mind. And I gave it to you on the 13th. I told you what to use, this shaded area. My longer term students to know that if we're bearish, we don't want to see all of the inefficiency respected, which is a breakaway gap if it's a fair value gap. But we've already worked inside this range already. But now we're treating it as a resistance. That means it can trade up to the low and reject and go lower, or we permit our analysis to see price trade up into the midpoint, which is consequent encroachment right here. So I'm going to take that level off. Here we go. So when we're trading at consequent encroachment here, and it's in London Open. We bump the high. We want to see price do what? Showing willingness to want to go lower. Does it sharply leave once it trades up in here, hits the buy side here, and then all of this back and forth movement that I'm showing you right here, all this here, price is spending time in that range. Is it efficiently delivered? Yes. Why? Because it's moved up, down, up, but it's only keying off of the levels I told you to focus on inside that shaded area. Consequent encroachment. We want to see, does it reject after bumping the high here? Yes. Once it leaves that shaded area, how did it leave it? Energetically? Yes. So now, enter model 2022. Buy side taken here. Shift in market structure there. Fair value gap there. I know. Corners of your mouth is hurting now. It's funny, isn't it? How this stuff just keeps randomly happening. All right, so we have our shift in market structure. We have our fair value gap. And then over here, what is this? What time of day is that? 8 a.m. So you're in the heart of what? New York Open Kill Zone. 7 o'clock to 9 o'clock. That's your little sweet spot. Your setup is going to form for continuation. You hold down control and drag. By the way, in case you want to know, I learned that from my students. All right, 7 o'clock. It can be left at 10 o'clock, but I'm going to show you the, oops, don't want to do that. A.m. And this is New York. Okay, so inside this little window of opportunity here, you're focusing on what? We've already worked up inside that consequent encroachment here. We've already seen the evidence that it wants to reject that. We have a shift in market structure. We have a fair value gap. And the market rallies up into what? Time of day. That's when the move's going to happen. New York local time, 7 o'clock in the morning to 9 o'clock in the morning. That's your New York Open ICT kill zone. This is the London Open kill zone. This is your premium array. The range is from this high down to that low. That's the lowest low. Here's 50%. A premium is at or higher than that. Does that fair value gap qualify as a premium array relative to that high and that low? Yes. Is price returning back up to that shaded area? Yes. Where specifically? The low end of it. It doesn't need to go back up to consequent encroachment. Oh. Consequent encroachment. It showed the signature that we would look for. It left the upper portion untraded too, again. Worked off the low of that gap. If you don't have these levels on your chart, or have them at least annotated in your notes that you're referring to throughout the day, now in the beginning, you want to definitely have them in your chart because it's going to take you some time to get used to seeing the market like this. But over years and years of time doing it, you'll be able to work off of a notepad and you won't have anything on your chart at all. It'll be a naked chart and it's okay. But it takes experience to do that. Okay, and obviously you can see how quickly, if you're not organized, you can get really, really lost working from one higher time frame down to the lower time frame. But by having the higher time frame logic and all these reference points in mind, suddenly these mystifying moves that come out of nowhere for you, and you don't know where it came from, and everybody's on social media saying, what the hell just happened? Where'd that come from? We don't have that here. You know, in this community, we come across as arrogant and many times as narcissistic because we know what the fuck we're doing. We know exactly what we're looking for. We know exactly how it's going to form, when it's going to form. And when we take it down and we share it with our tribe, the people on the outside, they get pissed off. They think, oh, they think their shit doesn't stink around here. Well, it doesn't, baby. It smells like roses and chocolate chip fucking cookies fresh from the oven. Whether you like it or not, I don't care. You don't have to stay here. But this stuff repeats every single week. Every single week it happens. Every single week. Now, every single day is not the same in terms of opportunity. Sometimes you'll see setups that are much more favorable than like we're seeing in lesser volatile days. But when we anticipate a direction in the marketplace and it's derived from a higher time frame weekly chart using the logic that I teach my students, that I've been teaching now publicly on the YouTube channel, it gives you the framework for one shot, one kill setups where you can get in and take a lion's portion of the weekly range out. It doesn't mean you're trying to get the entire weekly range. It just means that you need a small piece of it that will satisfy you. All right, so the idea of how far price runs can go, I'm going to use that here. Just for a frame of reference, I'm going to go back up to the daily chart. I'm going to encapsulate that entire down close candle here. We'll use a yellow. I don't really like yellow, but all right. So that's the entirety of the bullish order block, and the expectation is we want to see, does it want to gravitate lower and get into this area down here? Okay, and I'll hold off. I'll reserve doing that. You just have that on your chart as well. I'm gonna drop down into a 15-minute chart again. I know it's ugly, but this range is the entirety of the order block, and the expectation is we want to see it trade down to consequent encroachment and go below it. We want to see that weakness, that heaviness, because we want to see the move protract further lower, which would give momentum to being a long holder to stock index futures and foreign currency. This move right here, this move right there, that is your trigger swing. That's the measuring point for what you want to see for protractions or Fibonacci extensions. You take your fib, you anchor it, draw it down to the low of that price swing. Okay, I'm going to show you where my settings are again. I've done this in the past. I don't need them. And we'll put standard deviation 3 and 2.5. So here's where we're at. Close it. So we have a high to low, and the entirety of that daily order block is shaded in yellow. Notice that that Fibonacci extension negative 2.5, which is 2.5 times the range of the low to the high here. This is all I use a Fibonacci for, folks. That's it. Okay, I'm not in here looking for bat patterns and crab patterns and butterflies and all that stuff. I'm looking at math. Okay, that's it. This is the range that matters, and there has to be a confluence of time being London close. London close begins at 10 o'clock in the morning New York local time and ends at noon. There is a buffer I add to it. When there's a big runoff day, it can extend into 1 o'clock. It's far and few between. If you use just the 10 o'clock in the morning to 12 noon New York local time as your London close kill zone, it will serve you well. Okay? Huge step forward, Daddy. Watch. At 10 o'clock in the morning to noon, I hope you're having fun with this. I'm loving this. Should have charged admission. London close. Okay, so there's your London close kill zone. This thing's in my way. Kind of pisses me off now, actually. So now here's what I want you to look at. All right. These mysterious markets. Okay, we want to know where price can begin a move and where it can gravitate to. Where is it drawing to? It's drawing liquidity. And we want to frame it in the form of a low-hanging fruit terminus. The inception of a move can be timed. The inception of the move can be determined within a specific price level or within a range like an inefficiency. And in that range, 3 specific price levels. 3. That 3 levels is used on a basis of whether we're bullish or bearish. So as I was mentioning earlier, we were expecting this shaded area up here on the weekly chart, that old inversion fair value gap, to be treated as resistance. The algorithm would trade up into it during time. Notice that it reacted here. This is the essentially the midpoint or consequent encroachment of the entire range. But look at the time of the day. It's 1 o'clock in the morning. That's European open, yes. But the heart of the move, and what I teach by rules, is the high and the low of the day is formed between 2 o'clock and 5 o'clock in the morning. When we get here at 2:45, we're doing 2 things. Number one, we're bumping the high. So anyone that went short up here on dollar-based ideas and long foreign currency, I'm tempted to put the euro up here real quick, but I don't want to mess up the chart before I finish what I'm deciding. But we'll come back to this here, okay, in a second. But during the London Open kill zone, then it creates the high. You have a 70% probability of the high forming when you're bearish, when you're expecting the market to deliver, as I outlined on the 13th of June, 2023, going to a level I've outlined on the 13th. This level right here is your low-hanging fruit objective. That's not the end of the road. It means that you frame that idea of taking a trade with this as your draw on liquidity. But every single trade I enter, I always look for some kind of a best case scenario, something more than I expected, okay? Many times I don't ever get that. Sometimes I'll get stopped out. Sometimes it just simply doesn't give it to me and I change my opinion or mind about where I'm at and I collapse the trade, or I take too many partials off to justify holding on. And it's an evolving thing, and that's one of the weaknesses I've been very candid about. My exits are always a work in progress, and I've been doing this for 3 decades, so I'm not satisfied. My entries, if I never develop another entry strategy, I'll be fine. I got 81 of them, but you only need one. You only need one of them. So if you were to look at a breaker here, you have a high, low, higher high. Extend the breaker over, you'd be entering short there. If you're using optimal trade entry, okay? I had to fib up earlier. Let me do it again. If you're just using the old flagship pattern of my YouTube channel. And this one's going to come off. All right, so these 2 blue lines here, that is the classic ICT optimal trade entry, which is a standard 3/4 pullback. That high to low, it trades up into, I'm quite certain that's probably 70.5, which is the sweet spot that I teach on optimal trade entry. If you want to watch anything about optimal trade entry, if it's piquing your interest, I have many videos in this YouTube channel. Just do a search on my channel for OTE, optimal trade entry. That trade up into that right there is perfect. And it's just a beautiful run from there down. So you could use that as your entry pattern, okay? Entering on the fair value gap here, which is the 2022 model. So right away, there's 3 ways of getting in it. There's 3 different models to get in that same price move. Which one do you like? It's a matter of preference. But we have this run here to here, and we have a standard deviation of -2.5, which is just outside the scope of the entirety of that daily bullish order block, which is that shaded area in yellow. Let me take it back up so that way you know what I'm referring to. This down close candle here on the daily chart, right there, that I mentioned on the 13th, that full entire range. As soon as we start moving past midpoint, which is mean threshold, an order block's midpoint is mean threshold. Any inefficiency or gaps midpoint is consequent encroachment. The mean threshold here, if we trade through that when we're looking for lower prices and such, that really bodes well for leaving something on, like a partial. But it's Friday, so I've already told you I don't want to hold anything over Friday. into the weekend starting up on Sunday because of the gap risk that is available now because of everything that's been going on in the world. So anything can happen, and cause a major sentiment shift where we start trading from where we ended trading on Friday. So that gap risk is not something I'm comfortable with. And you may not have that concern. You may be trading with such an insignificant amount of money and don't want to incur a great deal of risk. And you are willing to take those larger risks based on points or pips, but they won't be so impactful because of the money management you're using. But if I'm taking a trade, I'm not taking a trade with a micro lot. You know what I mean? I'm trying to take something that has real risk behind it, and it will be much more impactful if I'm wrong and I absorb a gap that is adverse to my position that I held over the weekend. So that's why I'm saying it's better to be a day trader right now than there ever has been. So we have a confluence of a negative 2.5 level on the fib based on this price swing. And again, why am I using this price swing here? Because this is a trigger. It's occurring up to a level where we want to see it being respected as resistance, which is the low end of that old weekly gap. It's during the time of day, New York Open, where continuations would form, because the logic is we've already formed a high today. We're trusting, okay? How do you know, ICT? How do you know it's not going to keep going? That's what you use a stop loss for. Remember, I said it's a 70% likelihood if you have the narrative on side. That means you picked the right direction on the weekly chart. Sometimes I get it wrong. I get stopped out, folks. I mean, I've shared where I've gotten stopped out. You've seen where my winning trades stop me out and I don't get the full run. Like, I don't know why you're acting like I don't show it. I show it. And most of you are ignoring the fact that I'm telling you what's going to happen beforehand, and you're not using it to study it real time. When I'm pointing to it in advance, are you going through your charts and looking at it like this? Are you marking up your charts like this? This is a perfect example of what I'm showing. You should be doing these things. This is what you do. When I say back test, I'm not talking about go back in there and using a Forex tester and testing what it feels like to be in there. I'm not saying that that's not useful, but that's a mock up forward walk test. I'm not suggesting that. I'm saying you go back and look at old moves and you annotate your chart like this. And you save these. And in these little areas over here, you talk about and you annotate how the high was formed here at this time and the continuation in the high in the New York session formed here. And it delivered to a confluence of standard deviation negative 2.5 and breached the low of the order block.